So I'm going to record this. And so, Catherine, why don't you hit me with your question and I'll see if I can help you. Or maybe I'll just be like, I don't know, like that.
Okay. Well, I honestly, I feel a little silly asking it because it was one of the videos that they presented.
Uh-huh.
But I, for the life of me, could not follow what he was saying. And I watched it a dozen times, and I had the calculator out trying to get the same figures that he did. I could not do it. And it was the calculate average cost of each unit. It was problem 6-9A.
Uh-huh.
And I can't, for the life of me, I don't understand it.
Okay.
And then also the moving average. I don't understand that either.
Okay. And just so you know, I have noticed problems with this one in the past that for like 80% of the students, it'll be fine. And then like a handful of students, the rounding is weird. And so let's hope that you fully get the concept and it's just that the computer's being weird.
No, I can't even get it to close to the right figure.
Okay. So it's not a rounding issue or something?
No.
Okay. So let me ask you, I have the ability to pull up like the one you did so we can see your actual numbers.
Yeah, I didn't do it.
Okay.
I started to, but I couldn't figure it out. So then I went back to the video and I was watching it and trying to get going.
Well,
but yeah,
but what I'm saying is if you started it, then I can pull up that attempt.
Sure.
And then we're seeing your numbers instead of, because it changes the numbers. So if I pull it up just,
yeah, these I wrote them down. So I mean, I've got them, and
Okay.
It doesn't matter what numbers we use because I don't even understand the concept.
Okay. All right. So give me a moment. What I'm doing right now is I'm trying to multitask, and that's not something I'm skilled at. I used to when I was in the military, like that was like a big term at the time. And so I was always like all proud, I'm a multitasker. And then I finally just had to come to grips one day and be like, no, I'm not. I pretty good if I'm working on one thing.
Yeah,
especially because I'd be like, I'm a
to that
multitasker.
conclusion myself.
And then I compare myself to my wife and 9 kids and watching her juggle all that. And I'm like, nope, I don't have the same skill set. I'm pretty good at certain things. So this is chapter 6, homework part 2, right? That's where it's at?
Yes. Yes.
All right, just make sure I grab the right one. And then we have, let's see, Catherine with a C. It's like Anne with an A, except my wife said it was terrible, so I never watched it. It was some kind of Netflix original for Anne of Green Gables or something, and
oh yeah, that was kind of.
She felt like they besmirched something holy, is how she felt about it. So I was like, okay, I don't know how you feel. There's certain things you don't mess with. Like I think if they had messed up Lord of the Rings and made those movies terrible, she would have been pretty unforgiving about it. But let's see. So it's saying, it's telling me it's an unattempted question, so it won't let me see it. Dang it.
Right.
Sorry. Well, I was hoping it would let me still see the one that you had. So instead, I'm going to have to go to modules, and I'm going to have to go to Wiley Plus assignments. So if I go into the gradebook, it will let me see the actual thing that the student is working on, and that helps sometimes. Okay, but here I am in the assignments. And the other thing is when I go into the assignments, it shows me teacher view, which means it shows all the answers, which is cool, but sometimes it's helpful to students if I don't have all the answers up there at first. Okay, so let me share my screen now that I've got it up on there. Let's see, is my screen showing?
Yes.
All right, good. All right, so this is Sweet Acacia Industries. That's a cool name, I guess. They began on July 1st. They use a perpetual inventory system. During July, the company had the following purchases and sales. So let me try to size this a little better. So I can bring in my calculator as well. All right. So the first thing it tells us to do is to calculate the average cost for each unit. So what's tricky about this is, like on the first one, the average cost, we have 8 units. They cost us $71 a piece, so the average cost is $71. That makes sense, right?
Yes.
Yeah, okay. And then on July 6th, we still haven't purchased any units, so our average cost is still $71.
Yes.
So when we get down to July 11th, so it's really each time we make a purchase, that's going to change our average cost. And so now,
Oh, I'm sorry. On July 6th, they purchased and not sold.
no,
July 6 is sold.
we sold 6 units on July 6th.
Okay. Okay.
Yeah.
I'm with you.
So now we have 2 units remaining. In fact, instead of me using my calculator, I'm going to bring up an Excel worksheet. That'll make it clearer, I think. But it will mean I have to squish this over a little more. Come on, Excel. All right. All right. So on July 1st, I have 8 units. They cost $71 a piece. So I'm going to add, for my own sanity, I'm going to have a total cost column as well. Okay, which will be the number of units times the cost per unit. So that's units and unit cost. And then to find my average cost, I'm just going to take my total cost and divide it by the number of units. Does that make sense?
Yes.
Okay. I know it's pretty simple on the first one. And then on July 6th, I sell 6 units. So now I've got 2 units left that at a cost of 71. My total cost is just going to be the number of units times their cost per unit. And my average will still be 71, right? Because I have 2 units that cost 71 a piece. Does that still make sense?
Yes.
Okay. On July 11th, my son's birthday, I purchased 3 more units. So what I'm going to say now is I have 2 units that cost me 71, and I have 3 units that cost me 76.
Okay.
So again, I'll multiply that out. 2 times 71, and then 3 times 76. And I'll add those 2 together to get my total cost. And then I'll add the number of units together to get my total number of units. So on July 11th, I've got 5 units with a total cost of 71. Does that make sense?
You mean 370?
370. Does that make sense?
You kind of
I lost
cut
you.
out a little bit. So what I got out of that was that you added the 2 units. So now we have 5 units and the cost is 370.
Correct.
And okay.
So when I purchased 3 more units at 76, those units cost 228. So I now have 5 total units that cost me 370.
Okay.
And then to find my average cost, I just take the total cost divided by the number of units.
Okay.
Does that help, or does that make it more confusing?
Yes, that does. That
Okay.
helps a lot.
Okay. So on July 14th, now I sell 3 units. And does it tell me am I first in, first out, or?
On average, it doesn't matter.
Well, it kind of does. Well, not if I'm using 74. That's correct. So on July 14th, I sell 3 units. So now I'm going to have 2 units remaining with an average cost of 74. If I want, I can do the whole total. And my average, oops, is my total cost divided by the number of units. So when I sell, it won't change the average.
Right.
Okay, only when I purchase new units.
Okay.
So July 14th, I sold 3 of those 5 units. So now I'm left, on July 14th, I have 2 units with an average cost of 74. So on July 21st, I have another purchase, 5 at 82. So I'm going to say, as I already have 2 at 74, and now I also just purchased 5 at 82.
Okay.
So the total number of units is 7. And then to find my total cost, I'll take 2 times 74 and 5 times 82. And normally I would use my sum button and stuff like that, but I'm trying to show you the.
Yeah, then you just add those two together, right?
Yep. So now that's my total cost for 7 units. So to find my average cost.
You divide it by 7.
Yep.
Okay.
And then on the 27th of July, I'm just selling some. So again, that won't change my average cost.
Okay. No, that helps me a lot.
Okay, well, I'm glad. So that's the whole point. It's
Yeah.
worse. It's the worst when you explain something and you think, wow, I really explained that well. And the person's looking at you like, nope, that didn't help me. In fact, I'm more confused. Thanks a lot.
Yeah, no, I'm sure that's what it was. I'm just visual. I have to see it. And in the video, he just talked about it. So I was lost the whole time.
Okay.
And then the moving average.
So, okay. So let's see, determine the ending inventory under a perpetual inventory. So you were able to get first in, first out and last in, first out?
No, I didn't do it. I was
Okay.
struggling and then when I went out, it didn't save what I had done. So.
Okay. So let's kind
But
of.
I know how to figure the first in, first out.
Okay. Well, so let's start with the moving average one. And so let's see, the parts of the question, determine the ending inventory under a perpetual inventory system using each of those methods. Okay. So let's see. So we have our average cost of $79.71. Let's see. Oh, I know why, because I didn't do the last one. So on July 27th, we sold 3 units, leaving us with 4 units, right? Because we had 7 and we sold 3. And we had an average cost of 79. I believe we were supposed to round to 2 decimal places.
Right. So
So the total cost of that remaining inventory should be $318.84. Yeah, $319. Says round to $1. So all you're doing is saying, well, how many units do I have left in inventory? And times what's the average cost of that unit?
Okay.
Whereas on the first in, first out, we'd have to say, well, which units were they, right? Which were they on first in, first out, we would say, okay, we started with 8 units that were $71 units. Then we sold 6. That leaves us with only 2 of the $71 units. Then we purchased 3, which gives us 2 $71 units, and 3 $76 units right here. And then when we sell our 3 more, means we're selling all of our 71s. Would it be helpful if I worked this out, or just talking through it?
No, this is good because I
Okay.
understand this part.
All right, so and I'll be left with, at that point, I'll be left with 2 of my $76 units, right? Because those are my 2 most recently purchased. And then I purchased 3 more, or I'm sorry, I purchased 5 more at 82. And so when I sell those, I will sell all 3 of my $76 units that were, was it 3? Maybe I need to work it out. So all I'm left with is $82 units at the end. And so my remaining inventory is going to be 4 units at $82 a piece, and that'll give me whatever that comes out to, $328. And then on last in, first out, it's the opposite, right? So since we started with these 8, then we sold 6 of them, so now we have 2 of those left. Then we gained 3 more of the 76, and we sold all 3 of those. Then we gained 5 of the 82, and we sold 3 of them. We're left with, in essence, 2 of the $71 units and 2 of the $82 units in inventory, and that's how we're going to figure out the value of our remaining inventory.
Oh, okay.
Yeah, the one that did our on the one that I was in, he didn't get that. And he was trying to do the last out for things like, so
that hadn't been purchased yet?
For all of the ones that were sold. And it's like, no, wait a minute. You can't do that. You haven't purchased them yet.
Right.
First, you know, he was taking all the units and selling off the first 5 at 82 and then like that.
Right. So on July 6th, you sell 6 of those. So you're left with 2 at 71. On July 11th, whoops, I hit caps lock. You purchase 3 at 76. And you, let's see. And then on July 14th, you sell 3, and you're selling the most recently purchased ones. So on July 14th, so you're left with, you still have the 2 at 71. That's what you're left over on July 14th. July 21st, you purchase 5 at 82. And then on July 27th, you sell 3, and you're selling the $82 ones because those are the most recently purchased. So that should be minus 3. So you're left with, at the end of July 27th, 2 at 71 and 2 at 82.
Right.
Okay.
I'm tired of typing the plus symbol. All right. And that should give us 306, yeah. So does that make sense?
Yeah, so really the moving average is just the end of our average thing.
Right. In fact, I think that's why they set it up that way, so that you are figuring out the average cost of an item of a unit of inventory at the end of the month, and then you're just saying how many units do I have left, multiply it by that average cost, and that gives you your ending inventory.
Okay. All right. Well, that is clear now.
It's like regular accounting. What I mean by regular accounting is it's pretty easy, but it seems hard. And so you think it's got to be harder than this. And you try all these crazy hard things when the simple answer was, I say that until then all of a sudden there's a crazy hard one. And then you're like, oh, maybe that really was crazy hard. It's like parenting. No, wait, no, parenting is always crazy hard. All right. All right. So then the third one is just like, which produces the highest ending inventory valuation? So you're just like, that one, right? So it's first in, first out.
All right. And then just one thing that I want to clarify, because pretty sure I know the answer. But the way the book is talking, it's like companies can switch up what they want to do. But really, it's when you decide FIFO, that's what they stick with. You can't just go, oh, well, it's a really bad year, we're going to LIFO.
Yeah, so you can change, but you have to justify it. And the IRS is going to say, like, the fact that you think this is going to give you a higher net income this year is not really justifying it. So typically what you should do is you should choose the inventory valuation method that most closely matches the way you do business. So if you're in a business, say like a grocery store, who rotates stock, then they should use first in, first out, because they make a real effort to sell their goods in that manner. But some businesses don't. Okay, some businesses, maybe auto dealerships, they want to sell the new ones, especially their new car inventory. It might be different with their used car inventory, but the new car inventory, when they release a new model, they're putting a big push out there, and even the manufacturer is putting a big push out there, and so it might make sense for them to track that inventory on a last in, first out basis, because that mirrors how their real world inventory flow is. The Apple Store might be another example, right? They tend to try to sell the newer product faster. IFRS, so the International Financial Reporting Standards, they don't recognize last in, first out. This is purely an American thing. Other countries don't do this. But we've had it available for so long that it's kind of dying hard. But fewer and fewer companies are using last in, first out as a method anyway, just because it's kind of silly. I mean, like most businesses, that doesn't mirror how their inventory moves through inventory.
One question that I just popped into my head, because I had a couple, but this was the one that you helped me with was the biggest one. When a company has damaged goods, but they're still on inventory, but we weren't supposed to add that in or subtract it out of the balance, I wasn't quite sure what they did with those.
Okay, yeah, so when you receive inventory from a supplier and it's damaged, there's a couple things you can do. One is you can try to just send it back for a refund, right? That happens sometimes. Other times, what they'll do is they'll give you like a statement credit. I forget the term they use in the book. They use, it's not just credit. They use some term. Anyway, sometimes you'll receive inventory and they'll say, hey, this is damaged, but I can still use it. So like a grocery store will get some fruit that's suboptimal, and so, but they say, hey, maybe we'll take it over to our deli and we'll cut it up and we'll make a salad out of it and we'll sell that in the deli. So you don't have to give us our money back, but will you give us a credit on our statement to you for a portion of it? And so when that happens in a perpetual system, so when I receive inventory, I'm gonna debit the inventory account, right? Because that's an asset account. And then if I reduce the cost of that inventory, people always tend to think of the inventory account as like representing actual physical, tangible inventory. But the amount in the inventory account actually represents the cost of the inventory. So if I get some sort of a credit, I'm sorry that I'm drawing a blank on the term. Each book uses a slightly different one, and sometimes each employer uses a slightly different term for when a supplier credits you a little bit. So when I make the purchase, it'll be something like inventory 500, and then let's just say I pay cash. So that would be my first transaction. And then let's say I find out that my inventory is damaged. I contact the seller. The seller says, yeah, we'll give you a $200 credit. Well, let's say we didn't pay cash. Let's say accounts payable. So then the supplier will say, we'll give you this credit on your statement. In essence, all I do is I debit accounts payable. Well, wait a minute. I might be telling you wrong. That would be the simplest form. But this book likes to track sales discounts and sales.
Yeah.
Or purchase discounts and purchase.
I think it is accounts payable, but it's
right, but instead of reducing inventory, they're going to call it a
purchase. Yeah.
Purchase something.
Return
allowance.
Allowances. Yeah, return allowance. Or allowances and returns or something like that.
Yeah. Like that. And so the reason they'll do that, like some companies will do it that way, is they just like to be able to sort of like reconcile that at the end of the period and say, well, how much were my allowances, and how often am I having to do this with this supplier? Because you could, if you think about it, you could net that off of because your inventory is dropping. Okay.
Right.
In fact, that doesn't sound right. It seems weird to me. Is there a problem that covers this? Maybe we could look at. Do you remember?
It was last week's.
Sorry, I don't want to lead you astray. And like as I talk it out, it's sounding funny to me.
Yeah, it seemed funny to me the way they did it.
Let's see.
It was last week. It's in chapter 5 somewhere.
Sorry, I don't remember where it was.
Yeah, I'm reading, let's see, page 233, 234. Well, depending on where you're looking on the page numbers, the bottom of the book, page numbers. Accounts payable, cash. Okay, if it was cash, then it is inventory. This is one
I was looking for a problem we could work out.
The issue I had last week that I was going to ask about. So.
All right, so here's a good problem, 59A, that will kind of illustrate the point, I think. I knew there was one in there, I just couldn't remember which one it was. Okay, so but this is okay, this is why I'm getting confused. So this is a periodic system. In a perpetual system, we just go right back to inventory, okay? Right. And so that's why I was getting confused, because I started showing you what we would do with a return or an allowance in a perpetual system, which is we would just credit the inventory account and debit our accounts payable, and we'd be good. In other words, we just sort of like back the transaction out. But in a periodic system, you have to keep track of purchases, and you have to keep track of returns and allowances and all of those things, because you have to calculate your cost of goods sold at the end of the period, because you don't know it, right? So what you have to do is figure out, this is what I had on hand plus all my purchases less any allowances, and then at the end of the period say, well, here's what I have on hand now, and subtract it out, and the difference is your cost of goods sold. So and I think that's confusing. Like step one is you have to figure out, am I doing perpetual or am I doing periodic? Because that's going to change the strategy, I guess, for how you deal with it. So here they purchased these equipment, it was golf stuff, 1620. So they're going to debit purchases and credit accounts payable. Then they're going to pay their freight in. And then on the 9th, they're going to pay, let's see, okay, here it is on the 9th. Received a credit from Arnie Company for a merchandise returned, $320. So here they actually return the merchandise to them. So you'll just see their accounts payable going down, being debited, and then they're going to credit the purchase returns and allowances account. Okay. And
yeah, I remember where that question was, and it was in this week when they're talking about inventory and what belongs to what we add to and what we take away from.
So is in this week's stuff that the one you're thinking?
Yeah.
The actual question she was asking about, but I think last week's is kind of explains it a little bit.
Okay.
Makes some sense.
Do you remember if it was in part 1 or part 2? I know I'm asking tough questions tonight.
I think it was in part 1.
I know it was, we were going through and it, you know, told us this is what you have, and then what do we add to what, you know, it gave different, yes, something like that.
Let's see. So they're considering giving the Splish brothers a loan. Before they do, they want to talk to their accountant. One area of concern is the inventory account, which has a year-end balance of $247,680. Discussions with the accountant reveal the following. So they sold goods costing $50,590 to Hemlock. Okay, so they're going to make us go through and calculate out their inventory and see if this is right. So
Right.
Let me just bring this up. It may be helpful. It may make this process a little faster. Don't you wish you had that button? Show me the solution. Anyway, so in essence, we have to go through each one of these and make adjustments. So we're making adjustments to the actual ending inventory count. So they sold these goods. The goods are not expected to reach them until January 12th. The goods were not included in the physical inventory because they're not in the warehouse. So what we have to do is say, all right, so was this done correctly? And if it is, then there's no adjustment for it. So if we sold these goods for $50,590 FOB shipping point on December 28th, and then they're not expected to reach them until the 12th, our question is, should this be counted as part of our inventory during at the end of December? And the answer is, let's see. Did it say they sold goods? The goods are not expected. The goods were not included. So for each one of these, you have to say, is that correct? So it shouldn't be included because it was FOB shipping point. So freight on board shipping point means once we've loaded it on the truck, it becomes the property of the person we're selling it to. So we
right. And then in one of these problems, it says in this warehouse, in the corner, there's some damaged whatever, and that's where my question came from.
Okay.
It was not added in. I mean, I can't remember exactly if it was added in or wasn't. I mean, I figured it out, but I was just wondering why.
No, I think it's in the other problem, the 6-1A.
Sorry. Okay. See, this is why I don't have my own agenda, because I try to explain stuff and people are like, that wasn't my problem, buddy. Let's see.
Right here on G, isn't that what it says? Damaged goods set aside warehouse because they no longer available or sellable.
Right. So Riverbed Corp has damaged goods set aside in the warehouse because they're no longer saleable. These goods originally cost $433, and originally Riverbed Corp expected to sell these items for $557. Let's see. They're trying to determine the value of their ending inventory.
So the answer is not included, but I'm like, well, there's still inventory, so what do you do with them?
Right. Let's see, which is inventory.
I think that would depend on the seller, wouldn't it? Because if the seller says, okay, we'll give you a credit on it.
Right.
You could
so
having them sitting there, but you no longer have an investment in them.
Right. So here's the principle behind it. The principle is that we need conservatism, and what we mean by that is we want to make sure that we're not showing assets that we don't really have. Okay. So when we take a look at our assets and we say, well, are these really worth anything? Because remember, we're putting out these financial statements for our investors and for other people who would need to know. So if we have stuff that's no longer saleable, then in essence, we just have to write it off of there. So we would have to do a journal entry that in essence, so let's see, we use, what type of inventory system does it say? It doesn't.
It doesn't say.
So in essence, if we were using a perpetual, just so you know, like the vast majority of people use perpetual systems now. Computers have made that much easier. But so in essence, we would just enter a journal entry to remove those from inventory. And if we weren't going to get any sort of a credit back from the supplier or anything, then we would just credit it, or that we would just we would debit it as an expense to cost of goods sold. And some companies will carry a special cost of goods sold account, or like a sub account that they would call, damaged or whatever. But it's still, ultimately, it's part of your cost of goods sold. You had to pay for that inventory, and so you're writing it off.
Okay.
Yeah, sometimes you just have to write off inventory, as and again, depending on the business you're in. If you're in the grocery business, they have spoiled stuff all the time, right? That's just something they have to deal with. That's why when the bananas get old, then pretty soon you see banana pudding over in the deli, because they're trying to salvage some revenue out of that cost that's already been expended.
All right. Well, thank you. You've answered everything that I can think of.
All right. Hey, Matthew, I saw that you popped in. Did you have any questions or anything?
No, I didn't. I just thought I generally miss this, and so I just popped in to see what was going on. I'm not usually available this time.
Okay, well, welcome. Did you have any questions, Terry? I know that you said you think you don't typically have questions, but
Yeah, I had one that I was looking at. Only now I only have one screen up. I'm sitting downstairs instead of where my screen is, so when you're sharing your screen, I can't access my screen. So,
you want me to unshare mine?
Yeah, if you could for a minute, and then I could look at it and tell you what my question is. It had to do with, oh, I didn't take good enough notes. Okay. It had to do with, was this, I think it was, UK, you know what? I don't know. I didn't have good enough notes on it because I realized that I was supposed to be on here, and I didn't finish my notes. So let's see. Can I even get back to it? It was on the quiz, so I don't know if I can even see that.
Yeah, I could. I think I could access your quiz. Let me see.
Here it is. Okay, I can see it. Nope, that's the wrong quiz. Maybe I can't.
So we're talking the chapter 6 quiz?
Yes. Keep going to the wrong quiz.
So in the chapter 6 quiz, I show, let's see, you missed 2 questions.
The first it was the first one.
The average cost per unit.
Yeah. I don't know what I did.
Okay, do you mind if I share your question that
That's fine.
That other people can see the one you missed?
That's fine.
Like, never, I don't like to admit my imperfections.
No, because even when you make a stupid mistake and you realize it afterwards, it can still help someone else figure out something. So
sure. So I'm going to bring up Excel here again, and we'll just, let's see. So average cost per unit on August 12th must consider the 100 remaining. Oh, is that giving us feedback? So purchase on August 1st.
Yeah, that was feedback, the average cost.
Okay. So,
yeah,
so August 1st, we have 300 units, 1560.
On August 8th, we sell 200.
Leaving us with 100 at 1560.
Well, 1560, I think, is the total cost.
Oh, I'm sorry, you're right.
So and that's where it gets a little confusing. And I think that's
sorry. So 300. Okay, let's see. Following transactions. Oh, okay. So I have units, and then it's giving me total cost.
Right.
And so I'm going to have my average cost will be, not that I necessarily need it, but just so I can establish the pattern here. All right. And then on August 8th, I sell 200, leaving me with 100 units.
Right.
And
The
that still
average
have an
cost of
average
that
cost
was
of 5.2. And
Right.
then on August 12th, I purchase, let's see, 400 units.
Totaling
So to figure out my total cost here, I'm gonna have to take my average times my unit cost of 520.
Right.
And then I purchased 400 units at a cost of 1340. So that's gonna give me a total of 500. Whoops.
Yeah, I think this is where I think I just got
So
it.
I'm gonna have 500 units with a total cost of 1860, which is gonna be an average cost of 500, so 372. And then I sell 350
Yeah, but
units.
that doesn't
And
matter. Your answer is 3.
right. And I think they're throwing you off when they give you this amount here. That's like obfuscating information, because that's going to be, I'm assuming it's the retail value anyway, not the cost value. So it really
Right.
does throw you off.
Yeah, it definitely is the retail because you bought the 400 units for
1340. Right.
350 for 5,950. So yeah, I knew that. I don't know. I did something in my calculations wrong, and I don't.
Yeah, 372.
I understand it. I definitely understand it. I just don't know what I did wrong in my calculations. Okay.
All right. Catherine, did you follow that? That was similar to the other one, but it's a little different because instead of giving us the average cost and forcing us to calculate the total, or not the average, but the unit cost, here they just give us a total cost. And so,
Yeah.
again, when you make
I
a
was
sale,
actually able to follow along pretty good with that one.
okay, well, I went through it really quick, so I want to make sure it didn't, it seemed like you were getting that concept pretty well, but I didn't want to like add this change to it and not explain it if you needed it. So good.
I didn't even think about the 3,400 or the 5,950 until you said something. So I'm glad you said that, because I would have come across this problem and thought, oh, great, now what?
Right. Yeah, that's confusing.
And I think that's what caused me to make the error, is that it was backward from what we had been doing. And it's like,
right.
But I know I did everything. I'm just like, I'm not sure. Someplace I added something wrong. I did something wrong because, I came out with a different answer. So
the basic principle, whenever they're throwing this obfuscating stuff at you, the basic principle is sales of units do not change the average cost. Only purchases do. And I know that you know that, but sometimes that just helps with getting, for me, like I'm like, okay, what's the rule? The rule is each time I make a purchase, my average will change. And then I can go from there. Okay. Well, anything else? Or we've been here an hour, which is unusually long for one of these meetings. So I hope it was useful.
Very for me.
Yeah, I think it's good.
Quite good. Well, I enjoyed it too. We got to talk about Eastern Arizona College, something I love. Anyway. All right, well then why don't we, if we're good, then we can end with a prayer. And I started, so that means one of the two of you have to say it. Does anybody have a deep and abiding need to offer a prayer right now?
I don't have
a willingness?
deep abiding need, but I'll say it because I think Catherine said it last week since I wasn't on. So.
All right.
Okay. Dear Heavenly Father, we thank Thee for this day, and we thank Thee for this time that we've had to spend together and to study our accounting. And we ask that Thou be with us and help us to be able to retain the information and be able to do well on our exam. We ask that thou will watch over us and help us in our life, that we may do the things according to thy will. We say these things in thy Son, Jesus Christ's name. Amen.
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 Thank you. Well, have a great night.
Right. Thank you.
Thank you so much.